Could Ethereum really 50x from current prices? Some of the biggest names in finance are starting to think so. Avichal Garg, a former Google executive now at the center of crypto investing, believes Ethereum is only just beginning its rise. He argues the setup today looks completely different from what most people expect. For years, Ethereum was seen as risky and unproven, but that view is changing fast. Institutions are quietly moving in, new Treasury vehicles are buying every day, and regulators have given the green light for the first time. Ethereum just turned 10, and the next chapter could be its most explosive yet. The question now is simple. If Bitcoin already proved itself as digital gold, what happens when Wall Street decides Ethereum deserves the same recognition with even more room to grow? In this video, we uncover why a 50 times prediction is more realistic than what you think. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Before we fully unpack everything, let's hear it from Avichal Garg himself first.
If this thing works, in the same way that we talk about Bitcoin, it's just like, if it works, it's just worth a lot more than it's worth today. I don't know.
Is that like a 10x? Is that a 25x? Are you Tom Lee 100x?
Yeah, I don't think that's crazy at all. And I'll walk you through some math, right? I think when we think about Bitcoin, historically, we've always said, hey, look, if this is digital gold, gold's worth 20 trillion. You do the back of the envelope math and you factor in the Bitcoin that's been lost over the years and Satoshi's Bitcoin, that gets you to $1 million of Bitcoin pretty fast.
Yeah.
And if you do similar numbers for Ethereum, you're like, look, the comp here is some sort of store value like gold, and that's at 20 trillion, and ETH is at 400 billion today, then that's a 50x right there, right?
Ethereum at a $400 billion market cap may sound huge already, but compared to gold's $20 trillion valuation, it's still early. That simple math puts a possible 50 times on the table, and it's exactly why former Google executive Avichal Garg believes Ethereum is about to enter its breakout decade. But for Ethereum to truly make that leap, we need to understand the forces lining up behind it right now. So let's break down how Ethereum became recognized as real collateral, why Treasury companies are racing to buy, and what this shift means for the next stage of Ethereum's growth. For most of its life, Ethereum was treated like an experiment. Traders speculated on its price, developers built applications on top of it, but the traditional financial world refused to take it seriously. Banks and credit markets only lend against assets that are recognized as collateral. Treasuries, sovereign bonds, gold, and in some cases, blue-chip equities fill that role. Ethereum was not on the list. The skepticism lasted for years. Now that has changed. Avichal Garg points to the fact that Wall Street has crossed a line. Ethereum and Bitcoin are now being accepted as collateral by credit funds and debt markets. That unlocks an entirely new universe of capital. Funds can lend against Ethereum at single-digit interest rates, while the asset itself historically compounds far above that. The gap between cost of borrowing and expected return becomes the engine that Treasury companies can ride for years. Michael Saylor showed the world how this worked with Bitcoin. Ethereum is stepping into the same space, but with even stronger mechanics because of its staking and yield opportunities. This is the reason Garg calls Ethereum a multi-trillion-dollar opportunity. It isn't just that Ethereum has value, it's that the biggest lenders on the planet now see it as high-quality, liquid collateral. That phrase might sound dry, but in finance, it is the highest form of validation. It means Ethereum has crossed into the same category as treasuries and gold. Once that happens, the amount of money that can flow in is no longer limited by crypto adoption alone. It is tied to the vast size of global debt markets, which reach into the tens of trillions. The clearest sign of this shift is the explosion of Ethereum treasury companies. Just a year ago, the idea barely existed. Now, entities like ETHZilla, Consensus, Linked Vehicles, and other public firms are competing to lock up hundreds of thousands of Ethereum. They raise capital through share offerings, debt notes, and convertible instruments, then use the proceeds to buy Ethereum directly. These shares trade on the open market, giving institutions a familiar way to access Ethereum exposure without having to handle wallets or staking themselves. The scale is already astonishing. ETHZilla, barely weeks old, has raced past 100,000 ETH holdings. Tom Lee's Bitmine has set a target of 5% of total Ethereum supply. Peter Thiel's Founders Fund has also bought in. For Wall Street, this isn't about retail speculation or token flipping, it's about creating cash-flowing businesses that generate real returns. These treasuries not only hold Ethereum, but also stake it and deploy it into DeFi strategies. The result is a compounding machine, yield from the Ethereum itself, yield from its productive use, and price appreciation on top. Skeptics argue that these structures might overconcentrate Ethereum or expose it to leverage risk. That point deserves attention, but history provides perspective. In Bitcoin's case, MicroStrategy's aggressive strategy looked risky at first, yet it became the single biggest catalyst for institutional acceptance. Ethereum treasuries could follow a similar path. Even if some smaller players falter, the largest will survive, consolidate, and continue buying. Every cycle of consolidation leaves behind stronger entities with more Ethereum on their balance sheets. That is bullish in the long run because it means supply is being absorbed into hands that are not quick to sell. The more Ethereum is taken off the market into these corporate treasuries, the tighter the supply becomes. Combine that with the natural burn from the Ethereum merge and the steady demand from stablecoins and DeFi, and you have a recipe for scarcity. And at the end of the day, scarcity is what drives price. Garg's point is that treasury companies accelerate this process by introducing a steady mechanical bid for Ethereum. They are programmed to keep buying as long as they can raise capital, and the capital pools they are tapping into are enormous. Some ask why an investor wouldn't simply buy a spot Ethereum ETF instead of a treasury company. On the surface, ETFs look safer. They are regulated, liquid, and widely understood. But Garg argues that treasury companies hold a superior position. ETFs charge fees and are structurally forced to hold a portion of Ethereum unstaked to meet redemption requests. That means they can never achieve maximum yield. Treasury companies, by contrast, can stake nearly all of their Ethereum and pursue DeFi strategies that push returns higher. This difference matters. A treasury vehicle creates cash flow on top of Ethereum appreciation. Shareholders benefit from both the asset value and the yield multiple. ETFs offer exposure to Ethereum's price, but nothing more. Direct holding gives you control, but demands technical work, security risk, and regulatory friction. Treasury companies sit in the sweet spot. They bring professional management, yield generation, and scale that compounds over time. This is why institutions are choosing them. Norway's sovereign wealth fund doubled its Bitcoin exposure not by buying BTC directly, but by buying MicroStrategy stock. The same logic applies to Ethereum. When giant funds want Ethereum exposure, they will look to the companies with liquidity, cash flow, and credibility. That creates a feedback loop. The more institutions buy treasury shares, the more Ethereum the company acquires, the more its yield grows, and the more attractive it becomes to new investors. The cycle feeds itself. In the near term, this also supports Ethereum's price floor. Even during corrections, treasury companies are structured to keep buying. They do not rely on short-term hype, but on long-term capital flows. That steadiness is new for Ethereum. In past cycles, retail speculation drove booms and busts. With treasuries in play, a base layer of demand is locked in. It is difficult to imagine that not pushing Ethereum into much higher valuations over the coming years. Stablecoins have become one of the most important forces in crypto, and almost all of them live on Ethereum. This fact alone explains why Avichal Garg calls Ethereum a world-scale asset in the making. In his view, the growth of stablecoins ties directly into the value of Ether. The logic works like this. People all over the world want dollars. They want protection from inflation in their home currencies. They want a safe unit of account, and they want something they can send instantly. Stablecoins give them that. But when stablecoins expand, they also increase demand for Ethereum. Every stablecoin transaction consumes block space and adds to network security. The more stablecoins there are, the more Ethereum is needed to support them. This is the beginning of a positive flywheel. Demand for stablecoins grows, that demand pushes activity into Ethereum's ecosystem. To secure the system and settle the transactions, Ethereum is needed. As Ethereum rises in value, it attracts more institutions and more treasuries. Those institutions create more liquidity and more infrastructure, which in turn makes stablecoin growth even faster. The loop is clear. Stablecoins lead to Ethereum demand leads to more stability, and stability encourages more stablecoins. Garg stresses that this makes Ethereum very different from Bitcoin. Bitcoin has its own flywheels around scarcity and digital gold narratives. Ethereum's flywheel is powered by real usage, people moving money, companies issuing assets, and institutions building yield strategies. Stablecoins are not a side feature. They are at the heart of why Ethereum keeps gaining relevance. That is why he believes Ethereum is stepping into the same institutional adoption phase that Bitcoin went through between 2019 and 2024. For Ethereum to make sense as the foundation of this new system, Ethereum itself must be accepted as a store of value. Garg makes the case by comparing it to gold, silver, and even fine art. A true store of value needs certain qualities: portability, divisibility, durability, and scarcity. Ethereum checks all of those boxes just as Bitcoin does, but with two major advantages. Ethereum generates yield through staking, and Ethereum is programmable. Bitcoin does not offer either of those. He points out that humans once debated which metals counted as money. Silver was used as money across Asia well into the 20th century. Even aluminum briefly carried more prestige than gold when Napoleon used it for royal dinnerware. Gold won more by historical accident than by design. That means the path is open for new stores of value to rise. Ethereum is proving itself as one of them. Skeptics note that Ether has underperformed Bitcoin in this cycle. Garg acknowledges the point, but explains the reason is timing. Institutions had clear access to Bitcoin through ETFs and products like MicroStrategy before they had similar access to Ethereum. Compliance departments allowed Bitcoin exposure first. Only recently have major banks and brokerages opened the gates for Ethereum ETFs. That means Ethereum's institutional bid is just beginning. Retail cycles may look slow, but institutional cycles are measured in quarters and years. Once the pipes are open, they rarely close. The delay is not a weakness because in fact it is a setup. This is why Treasury companies are doubling down. They know Ethereum has already passed the hardest test, surviving a decade. 10 years after launch, Bitcoin was worth $66 billion. 10 years after launch, ETH is worth $350 billion. The trajectory is stronger. With ETFs, with treasuries, with stablecoin expansion, Ethereum is entering the stage where institutions finally recognize it as more than a network. It is an asset worthy of long-term storage of value. Ethereum offers more than a place to park wealth. It offers yield opportunities that are native to the network itself. Vanilla staking gives returns above 2%. Layered strategies and DeFi protocols can offer more depending on risk tolerance. Treasury companies like ETHZilla are building frameworks to deploy Ethereum into these strategies in a measured way. They focus on safety, using tested codebases and liquid protocols while still capturing higher returns than staking alone. This sets up another potential flywheel. Treasuries buy Ethereum and stake it. Some of that Ethereum gets deployed into DeFi. The protocols gain liquidity, which makes them stronger and safer. That strength attracts more users and more capital. The cycle repeats. If billions of dollars flow into DeFi through treasury companies, Garg argues it could trigger an afterboom. The first DeFi summer in 2020 was full of experimentation. Many of the protocols worked but were too early. Now, with treasuries as steady capital providers, the timing aligns. Concerns about leverage and risk do exist. Critics point to BlockFi and Celsius as examples of what can go wrong. But Garg explains the difference. Those companies rehypothecated assets and created loops of risk that unraveled. Treasuries are not built that way. Their debt is collateralized and structured to avoid cascading failure. Even in bear markets, they can refinance rather than liquidate. The model is safer and it is tied to cash flow rather than speculation. This is why he believes Ethereum treasuries will play the same role MicroStrategy played for Bitcoin. They will become the bridge between Wall Street and crypto, but with the added benefit of productive capital. The cash flow they generate can be reinvested back into Ethereum and back into DeFi. That makes them not only holders of Ethereum, but active builders of the ecosystem. It is the equivalent of Warren Buffett's Berkshire Hathaway, but powered by digital assets instead of insurance floats. The endgame is powerful. If Ethereum treasuries grow to hold billions, they could generate more annual cash flow than the entire Ethereum Foundation's budget. That cash can fund new protocols, secure the network further, and keep the flywheel spinning. Every cycle of growth reinforces ETH's status as the central asset of the on-chain world. What do you think? Could Ethereum really 50 times from here? And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.